Is gold's recent 8% plunge a disaster or the buying opportunity you've been waiting for? Could the US September inflation data determine whether your portfolio thrives or crashes in the coming months? And here's the shocker. What if gold prices are set to surge, regardless of whether inflation is controlled or spiraling out of control? Gold has been riding an absolute roller coaster lately. Just weeks ago, prices climbed aggressively, driven by the No Kings protests and regional banking concerns. Then, October 21st hit. Markets suddenly buzzed with rumors about the Russia-Ukraine war potentially ending, and gold crashed over 8% in a single session. Investors are completely confused right now. Has the gold rally finally topped out? What's the right move from here? Today, we'll be analyzing two possible scenarios and revealing the ultimate gold play. If you're holding gold right now or searching for the next investment opportunity, then you absolutely need to watch this. Let's examine the first extreme scenario: US inflation spiraling out of control. Wait, how is loss of control even possible? Four major drivers create this risk. The first driver is persistent imported inflation. Tariff policies from the Trump administration continue creating lasting effects. If US-China trade tensions escalate further, imported goods prices for American consumers will keep climbing, pushing inflation higher through what economists call imported inflation pressure. The second driver is government overspending. The government continues spending beyond its means while debt levels climb relentlessly. This risks flooding markets with excessive money supply. With economic growth already slowing, the federal government may resort to massive fiscal stimulus. This approach rebounds domestic demand, naturally pushing prices higher across the board. The third driver is geopolitical risk escalation. The Russia-Ukraine war shows no signs of quick resolution, and the Israel-Palestine conflict could reignite at any moment. These situations push energy prices upward, inevitably increasing costs throughout the consumer goods supply chain. Lastly, the fourth driver is weakening dollar hegemony. If the dollar's position as the global reserve currency weakens substantially, US import costs increase dramatically. Goods prices will surge, intensifying inflationary pressure even further. These factors don't operate in isolation. They interact and reinforce each other. Future inflation rates will likely get pushed significantly higher, especially given current global economic uncertainty, making market conditions even more volatile and complex. So then, when inflation loses control, why does gold explode higher? First, gold's inflation protection becomes exponentially more valuable. When inflation surges, dollar purchasing power evaporates rapidly. What buys a pound of meat today might only buy half a pound tomorrow. As confidence in fiat currency erodes, people convert cash into the ancestral hard asset of gold to preserve wealth. Increased buying drives demand higher, naturally pushing gold prices up. Second, real interest rates reduction. When inflation spikes, real interest rates, calculated as nominal rates minus inflation, drop sharply and potentially turn negative. Holding cash in bank accounts or treasury bonds becomes far less attractive than holding gold. The result? Gold prices rise again. Third, the dollar weakens substantially. Uncontrolled inflation damages the dollar's global standing. Other nations reduce dollar holdings in their foreign exchange reserves, causing dollar depreciation. Since gold is priced in dollars, a cheaper dollar makes gold more affordable for international buyers. Increased global demand pushes prices higher. Finally, chaos always favors gold. During periods of uncontrolled inflation, economic turbulence increases dramatically and government policies become increasingly unpredictable, creating widespread market uncertainty. Gold's safe haven properties shine brightest during these periods. Regardless of economic volatility, gold maintains relatively stable intrinsic value. People accumulate gold for financial security, and increased buying naturally lifts prices. Historical precedent strongly supports this pattern too. During the 1972 US hyperinflation period, gold prices surged dramatically, delivering extraordinary returns to holders. What do you think? Is the probability of US inflation losing control high? Share your thoughts in the comments below. Now, let's examine whether gold continues rising, even if inflation remains perfectly controlled. Next, let's examine the second scenario, which markets generally consider more probable. US inflation remaining well controlled. Recent data shows the University of Michigan one-year inflation expectations index peaked at 6.6% in May before gradually declining. This indicates medium-term US inflation pressure remains manageable and contained. Inflation stability depends on several reinforcing factors. First, weakening labor markets, slow wage growth, reducing consumer spending power and corresponding downward pressure on goods prices. Second, slowing U.S. economic growth represents a major structural trend, naturally decreasing aggregate demand. Finally, energy prices should remain relatively stable, significantly reducing imported inflationary pressure from overseas. This raises a critical question. If declining inflation weakens gold's inflation protection appeal, why would gold prices continue rising at all? The answer is relatively simple. Declining inflation represents the key catalyst enabling sustained Fed interest rate cuts. High interest rates effectively suppress inflation, but maintaining them indefinitely drains economic vitality and risks triggering recession. When inflation declines, the Fed Reserve has more room to cut rates. Rate cuts make borrowing cheaper, revitalizing economic activity while preventing sudden economic collapse. Now listen up, because the Fed rate cuts provide massive structural support for rising gold prices. And here's why. Gold generates absolutely no yield. Rate cuts reduce returns on treasury bonds and bank deposits substantially. This narrows the yield gap between gold and traditional income-generating assets. Investors become far more willing to allocate capital to gold when the opportunity cost drops. Consider this example. From September to December 2024, the federal funds rate dropped from 5% to 4.5%, with short-term treasury yields following downward. During that period, gold prices climbed from approximately $2,493 per ounce to $2,718 per ounce, gaining over 9% in just 3 months. So, whether inflation loses control or stays perfectly controlled, gold rises either way. That's great news for gold investors. But wait, what's the logical explanation to this seemingly paradoxical outcome? Regardless of whether September inflation data released October 24th comes in above or below the market consensus expectation of 3.1%, both outcomes create powerfully bullish catalysts for gold prices. In the first outcome, that inflation data exceeds 3.1%, it signals rising loss of control risk. This directly triggers 3 explosive drivers working simultaneously. Real interest rates decline sharply, the dollar depreciates against other currencies, and safe haven demand surges dramatically. These 3 powerful forces combined push gold prices directly into an explosive uptrend channel with substantial momentum. Now, in the second outcome, that inflation data meets expectations or falls below 3.1%, it confirms controlled inflation. Once inflation appears well controlled, markets immediately strengthen Fed rate cut expectations for upcoming meetings. And what do rate cuts fundamentally mean? They mean gold's opportunity cost drops compared to alternative investments. Capital flows rapidly out of yield-generating assets like bonds and pours aggressively into gold, continuing to push prices substantially higher. This creates what we call a two-way insurance policy for gold investors. High inflation drives powerful gains, while low inflation also drives powerful gains. From pure risk-return perspectives, gold represents the single most reliable investment opportunity available in current market conditions. This framework reveals something critical. Any short-term price pullback could potentially offer an opportunity for strategic buying in. Buy-and-hold strategies may deliver exceptionally strong returns for patient investors positioning ahead of these catalysts. Tell us, do you favor short-term strategies like shorting US equities, or long-term approaches like accumulating gold positions? Drop your thoughts in the comments. If you found these 2 scenarios helpful in identifying your next gold play, be sure to give this video a like and share this with a friend who might appreciate this analysis. Subscribe to Trading Key, hit that notification bell, and we'll see you in the next video.